Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have another of our sponsor webinars. I'm proud to introduce Jim Hearn and Ernest Johnson with ApexOne. They're going to go over their new Special Situation Fund 4. So as usual, the first half of our webinar, we'll let them do their presentation. And then in the second half, we'll go through our Q&A. So if you have any questions during the webinar, please type those in, and I'll ask them at the end. And please keep yourself muted, please, because I will. It's distracting. And at the end, I would ask the question. So welcome, guys.
Thank you, Mark. Good chatting with you here for a few minutes and earlier today. I'm Jim Hearn. The other pictured guy, Ernest Johnson. I can see from the names that keep popping up that we know a bunch of you folks from prior investments, and we appreciate that. And we're excited about this new fund. And without any ado, I'm going to pass this all over to Ernest to tell you about Special Situations Fund 4.
Well, great. Again, welcome to the 506 Group. You all have been incredible supporters of our programs, and we hope you're enjoying the benefits of the investments we've been making. You are the first group that has seen this. We've previewed it with a couple of individuals to get feedback, but today is actually the first launch of the marketing program for the fund. So welcome, and any feedback we would appreciate, and we'll certainly incorporate that into future presentations as we go forward. So I'm going to jump right in here. First off with our usual disclaimer. Sorry, I guess I should leave that for just a second to let you know there is one, and additional disclaimers in the back. The executive summary, the Special Situation Fund 4, what we're doing is we're seeking to capitalize on pricing dislocations in the multifamily sector that's going to be created by the COVID-19 pandemic and the ensuing economic recession. The underlying belief here is that apartments are sustainable, and while they're not recession-proof, they historically and significantly have outperformed other real estate sectors during and following a recession, and we're going to show you the basis for that statement. In summary, I think what you're going to see over the next few slides and in this presentation is that traditionally and historically, multifamily is always the last real estate sector to experience a rent decline. It has the shortest period of rent decline. It's then the first sector to recover back to pre-recession peak. It tends to have the longest duration of rent growth, and then it has the longest run of sustained rent growth of any real estate sector. So let's look at the last two recessions that the country experienced, not including this one, and see what happened to the various real estate sectors during and after and through the recovery period. So the 9/11 recession popped up in late 2001. And as you can see, the three primary food groups here, multifamily rent declined 6.7%, industrial 7.4%, and office 17.7%. And then once it recovered, multifamily grew by 10% up through the next downturn, industrial 4.3%, and office 5.7%. To give you a little better picture of that, this is a timeline, and the orange line on the far left, that is actually the official end of the recession according to the National Bureau of Economic Research. But what you're seeing is that multifamily rents declined for 9 quarters, industrial 15, office 13. Thus our belief that they have the shortest period of decline. It then took multifamily 7 quarters to return to its pre-recession peak, and then grew for 12 quarters until the next downturn. The other two food groups, didn't fare as well. Longer decline, longer climb back up to pre-recession peak, and then not as long a period of time to grow their rents until the next recession hit. So then the next recession comes in 2008, known as the Great Recession. Again, rent declined 7.9% in multifamily compared to 17.5% and 17.7% in industrial and office. And we've thrown retail in here just as a bit of a measuring stick. It declined 14.1%. After multifamily recovered, it grew 25.7% until the beginning of the next recession. Industrial 7.8%, office 5%. And this is what's interesting about retail. Retail has not recovered to its pre-recession peak. So rents that retail was getting on average in 2008 is higher than what they're getting in 2020. And a lot of that is the introduction of e-commerce and industrial being the new retail and just the changing face of retail, but we just have that in there as a measure. So looking at the timeline, again, multifamily dropped 5 quarters, industrial 13, office 9, and retail 21. Multifamily recovered 7. Remember, the reason multifamily recovers so well post-recession is because what leads you out of a recession is job growth. And with job growth, it is one of the few indices that we can tie with rent growth in our sector. So as soon as those jobs start getting created, people start looking for places to live, a new place to live, roommates split up, people move out of their home. We just see an expansion in people moving and families being formed, and you've got to have a place to live. Again, going to Maslow's hierarchy of needs, food and shelter are at the very basis of all our foundations. It's not industrial, it's not office, it's not retail, it's food and shelter. And again, that's why this recovers so quickly in multifamily. And then because it recovered so quickly, we had the longest run of rent growth, that 25%. And this is actually through the end of 2018, which is the last measuring stick we had. So if you throw 2019 in there, it actually grew for 33 quarters. So again, multifamily, just a strong performer in the recovery of the real estate sector during and following a recession. So with that in mind, let's look at what's going on right now and compare it to the Great Recession. What we're looking at here is volume. What has happened to real estate transactions since we peaked in January of 2020? But the important thing to look at first is that green line. This is real estate volume activity before and then after the great financial crisis. And you can see in that green line, it is a gradual downward slope that took about 20 to 21 months before it bottomed out and volume started recovering again. But now look at what's happened in the current recession, the COVID recession. We literally have fallen off in 4 months to the point that it took almost over 20 months for the Great Recession. So what this is telling us is we think the buying opportunities are going to come pretty quickly. And we also don't think there's going to be as much of a discount. And we'll talk about that in a minute. And so with this in mind, the question comes up is, what are you going to buy? And where are you going to be buying? So one of the things that we've done, and I won't get into the weeds here, if we have some time in Q&A, I'll show you, but ourselves and our partner, Balfour Beatty Communities, have spent a lot of the last April, May, and June looking at markets. We have evaluated every market in the country. I think there's 3,182 counties in the United States. We have looked at every one of them and ranked them by demographic information that we can pull from various sources, such as average income, income growth, income versus national average, new development of multifamily units, multifamily absorption, multifamily rent growth, all these different dynamics. There's literally thousands of data points that we use, affordability index, to sort of look at all these to try to figure out what's going on out there in the economy. We then took and applied these 8 subjective items to our data points we mined, and then came up with a ranking system. What would these cities be? And I am going to take just a second here and share another screen with you to show you what this report looks like. So hold on one second. And this is actually be part of another presentation we do, not today. But Mark and Jim, y'all should be seeing the fastest stabilizing markets.
Yep.
So what we did here was we took these 8 points: pre-COVID growth and rental demand, diversified employment, strong healthcare and medical facilities, stronger state unemployment funds, research tech innovation hubs or university anchored towns, ease of access and transport, a good climate, and managed supply. That is, it's not very easy to build. So we applied these 8 subjective variables to these demographic points we found to start looking at different cities. And so this chart, I'm going to zoom in a little here, guys and gals. Get my zoom feature here.
There we go. Now you're cooking.
Now I'm zoomed. So what we did was we started looking at some of these variable factors, how we would categorize them, such as strong healthcare. Houston has the largest medical center in the world. It is known for that. Philadelphia, Baltimore, Boston, cities with strong healthcare. previous high growth, markets that were growing strong and had good sustainable economies before COVID-19 and had characteristics that would lead them after COVID-19. Areas of research, Mark, you'll appreciate this, the Raleigh-Durham area, probably the #1 research area in the country, Atlanta, Boston, Provo, Austin, etc. Logistics and transportation centers, Dallas, Atlanta, Memphis, major airports, Memphis, the geographic center of the country. There's a reason FedEx is located there and why we buy properties in Memphis. Cities that were COVID resilient because of the economy, because they had big government presence or other employers such as major university systems, banks, and finance that have been somewhat less impacted by the COVID virus. And then locales with unique characteristics. And so we kind of grouped these and started identifying cities. And then so from that, we pulled up this chart. We broke it into large recovering markets, faster recovery, large markets. And faster recovery, we mean they think they'll have significant recovery within the next 12 months. And then the primary drivers behind them. And so you see those large, fast recovery markets listed here. We then went to the faster recovery small markets, Ann Arbor, I grew up in Huntsville, Alabama, so I know this market. Huntsville is destined to be the next Austin, Texas. There are more PhDs in Huntsville, Alabama per capita than any city in the country, maybe the world. And primarily that's because that's where NASA was located. Everybody thinks of NASA as Houston, but Werner von Braun and his rocket scientists actually settled in Huntsville, Alabama, and that's where the attraction was. And in fact, when I grew up in high school, the big joke is, so what is your dad, a rocket scientist? And you go, well, yeah, actually he is. So we started discovering these small towns that started popping up for different reasons. So then we started looking at the towns that would take longer than 1 year to recover, that had a 2-year cycle, which ties in with what a lot of the economy that we're seeing. And so some of the similar characteristics of the faster growing markets, they had a steeper impact to employment during COVID-19. That is, they were more exposed to job losses. Historically, they've done extremely well, and they have unique characteristics. So Houston, Texas, not only got hit hard by COVID, but it also got impacted pretty big by the oil industry. But it is an oil town. It's the energy capital of the world. We have the largest healthcare system out there. We have a great logistics transportation. So it will recover. But there's a lot of apartments being built down here. It's going to be a little slower. Orlando, again, Disney and Universal is located there. Your 9-year-old daughter could care less about COVID-19. She wants to see Snow White. She wants to see The Mermaid. She wants to see Disney. You're going to find a way to get her there. The people that run Disney are pretty smart, and they're going to figure a way to get that place opened and running as fast as anyone. So again, we think that'll be a good recovering market, but it might take a little bit longer. Las Vegas, Miami. Miami is the gateway to South America. Again, with the lack of travel between South American countries and the U.S., we think there'll be a pent-up demand eventually, but Miami will be a recovering market because it's such a gateway. And then, of course, Jacksonville, Florida, because of the port and logistics, but it had a large leisure hospitality industry, so it suffered. So anyway, just to show you some of the research that we've been doing to try to identify these cities and where we'll be investing over the next few years with this fund. So if again, look in the background, you'll see some of these, where you see the bigger dots are cities that have a lot of characteristics that'll lead to recovery, such as the Tampa, St. Pete area, in and around Atlanta, up and around Nashville, Tennessee, the Carolinas, San Antonio, and Dallas, big recovery markets. So this is where we think we're going to be buying, and it's not going to be restricted to these communities. But what our data compilation allows us to do is when we see an opportunity come into us, we can jump on it very quickly and start analyzing that data. The other thing we've been doing over the last few months is our head of acquisitions, Tim Burns, David Steele, and Jim's been doing some as well. We have been out meeting with real estate brokers throughout the country. We've done a lot of deals. Actually, a lot of these brokers have invested in our funds, and we've done a lot of deals with them. And we've been going to them and asking them what they think about the fund, been telling them the opportunity that we see out there. And I think what we're really trying to stress to the investors and the brokers, We are not looking for distressed properties. We're not looking for properties where there's some problem that's got to be fixed, that's going to take time, that increases the risk. We're looking for properties from distressed sellers. We're looking for places that money, time, or experience can cure the problems. And we'll discuss that in a minute as well. So anyway, so we've been out meeting with these brokers, and what's been interesting is literally to a person, they've all asked if they can invest in the fund. And then they said, hey, as we find deals, we're going to bring them to you. And so sure enough, we've been finding and seeing some transactions, most of them off market, or most of them a very limited market. We recently put a property under contract for Fund 3. We've been looking in the Little Rock market for some time, for about 3 years, and just trying to find that right deal that we thought would give some good returns. And most of the properties we saw were being priced, Jim, I think is in the 145 to 160 range, and we just couldn't quite make them. We knew the area of Little Rock we wanted to be in, the brokers who wanted to be there. So 3 weeks ago today, we received a call from a broker saying, I've got a property in Little Rock, it's off market. The sellers do not have time to go through a marketing program. You need to respond to this really quick. We knew the property because we've been up there so much. Long story short, we put in our offer. We were not the high bidder. I think 3 other groups bid on this property. And we had our buyer interviews on Monday. So 5 days later, we had buyer interviews with the sellers. Ours was at 6:30 in the afternoon. And when we finished the interview and told them what we were doing, our experience, we knew the market, we knew their property, the advantage we brought with our select sponsorship with Freddie Mac, the fact we had money to do the deal. They turned to the broker basically in the call and said, well, Blake, you were right. These are the guys to buy the property. We'll accept their offer, do the paperwork. So we ended up buying that property at $115,000 a door, basically a $30,000 discount. The owner was actually a construction company. They built the property. It is built like Fort Knox. It's so well constructed. Their problem is they tried to manage it themselves and couldn't. It was a disaster. But we can go in and fix that. We can recover that. And it's going to be a really strong performer for our Fund 3 investors. So that's what we've been doing the last few months, our research and getting out there in front of the market with everybody. So this was a question that people had. During the last recession, following the Great Recession, if you remember that long, slow slide of real estate transaction volume where you had kind of a nice little going down, prices dropped. And what really happened, though, was volume dropped. And those of you that remember that recession, you remember a couple of characteristics. The reason the slowdown in volume wasn't because properties dropped in value so much, is there was no debt available. The debt markets had been absolutely tapped out. What debt was available was at a pretty high interest rate, pretty much twice. I think that the discount rates were almost 5 back then, and then plus whatever spread on top of it. You were happy to get 50% financing, and your equity was expensive. So properties had to drop in value just to attract capital and debt to them. And it was over a slow period of time. And so they dropped about 35%. And so we didn't think there was going to be that drop this time because, frankly, this is the first recession where there was not an extensive amount of overbuilding in the real estate sector, especially in the multifamily and single family housing leading into the recession. So we entered this recession with a very tight housing market. In fact, a shortage of housing in the workforce and affordable housing sector. So we came in pretty well prepared. But we wanted to see how much do properties need to discount in order to achieve a 16 to 18% net return to investors, taking into account our new, what we call our draconian underwriting measures, where we're writing in either negative rent or flat rent for 12, 18 to 24 months. We are looking at occupancy averages down at 88% as opposed to 93 to 95%. We are putting a 6-month reserve of capital, of expenses into the deal for mortgages and expenses, et cetera, and loading that into the deal as well as a safety net. So when all that is said and done, we wanted to see how much do prices need to drop in order to generate that 16 to 18% return, and then what would the multiple be on those investments. So what we found is they really didn't have to drop that much. So we took deals that we knew, a deal we had closed, and used that as our pre-recession base case. And there's 2 slides here. The one on the left is if we did the deal 100% equity. The chart on the right is if we use equity from a joint venture partner, and I'll walk through that in a second. So we looked at the deals in terms of if there was a 5%, 7.5%, or 10% discount. Most of the discounts we're hearing about out there, just in talk, is about 8 to 12%. So we think we're within a pretty good safety range. But what you'll see is at a 5% discount, the IRR, which is represented by the green line on the bottom of the left chart, at a 5% discount, you hit about a 15% return and about a 2.3 multiple. At a 7.5% discount, you hit a 16 return, which is our target, and about a 2.5 multiple, well within our range. And at a 10% discount, you're looking at about a 17.5, 17.8 return and a 2.8 multiple. So that's with those discounts and those pretty dramatic underwriting standards that we're using. Now, if you look on the chart on the right, if we bring in a joint venture partner, and we've done 40 joint ventures at ApexOne, if we were to put in 40% of the equity and our joint venture partner puts in 60%, and then after an 8% preferred return to both investment entities and a return of all their capital, the fund would get 60% of the distribution, the JV partner 40. And what I would tell you is that's a very conservative joint venture arrangement. Most of ours are much better than that for the fund. So that underwriting, that joint venture structure with the same underwriting now takes a 5% discount to about a 20% return and a 2.7 multiple. And you can see at a 7.5 and 10, it goes up dramatically. So what's different between now and the Great Recession? Well, we've touched on those. One, we still can get 70 to 80%. We still use 70, 80% debt on our properties. We've underwritten most of these deals at mid 60s. Debt is available to us from Freddie Mac as a select sponsor. Those of you that aren't familiar, we have a full-time team assigned to us that works only on our properties, and we have them year-round. So we get the same people every time. That speeds up the underwriting process. It also gives us a discount on our funds of 20 to 50 basis points. We're getting cheaper money baked into the deal. So the fact that we can get good debt, that our equity is inexpensive, allows us to hit these multiples. Looking at, going back to funds that were formed in 2009, 10, and 11 after the last recession, you'll see the returns are a little different. And we've run them over a couple of years because if you remember, there's that slow descent down to the bottom of the volume where people started buying again. And so we averaged the 3 years because we think that's a more accurate reflection of where we think we're going to be in the buying over the next 6 to 12 months. And sure enough, those funds average about a 17.9 IRR. But again, they had to use extensive amount of equity, higher interest rates, and thus their multiples were a little lower. So what this tells us is our analytics show that with a small discount, 5 to 10%, and a joint venture partner, we can exceed the return anticipated, the returns that were shown during the last recession funds that came in after the last recession. And the other interesting point to note, these numbers come from Preqin, and we use Preqin for this analytics because Preqin requires anybody who submits returns, and it's important to be listed in Preqin, it's a ranking system. You have to either have a full audit with your return audited and signed off by the auditors, which ours is with Weaver and Tidwell, or you've got to report to a big institutional investor like CalPERS or CalSTRS and have a certified letter that goes to them. So Jim and I can't just call Preqin and say, yeah, we did 25.2 on our last fund, put it in there. It has to be validated, it has to be verified. So we, like using their data. We think it's the most accurate way to report it. So that gets us down to what are we looking to acquire? And I think also this is what begins to separate Fund 3 from Fund 4, and we'll talk about that in a minute as well. We're certainly looking, again, for those distressed sellers that have assets with inadequate capitalization, which can be acquired below replacement cost. We're looking at assets and markets impacted by COVID-19 that we believe will recover during the ensuing economic expansion. Properties in market that are become overbuilt in the short term but have a clear path to rebalance. And what's really unique about this fund is we can actually acquire debt. We can acquire a loan that's not performing, or we can go and assume debt from somebody else. We don't have a restriction on leverage, which doesn't mean we want to over leverage the properties. But let me give you a couple of examples of deals that we've seen. We were put in contact by a friend, a broker, about a development deal in Austin, Texas. Development's finished, 62% leased. The developer is at the end of his construction loan period. He's not leased enough to switch it to a mini perm, so he's got to bring in new financing. He doesn't qualify for a loan. He's used up his balance sheet, so he can't extend it. He just wants out. He's completely lost his carried interest in the deal, and so he would sell that at a discount, and we would come in and assume the lease up. Well, if we can buy that at a discount in Austin, Texas, which is still the #1 market in the country in terms of where people would like to live, that would be an example of buying from a developer below replacement cost at a lower price point. We saw another deal in Fort Myers, Florida. It was a age-restricted housing, 55 and older, not a senior living facility, but age-restricted. Developer had way over, the owner had way over leveraged it. There was a $63 million loan, I think, on this property, valued at about $100 million in its heyday or when they underwrote it. It's on the water in Fort Myers, overlooking the marina, irreplaceable location. There's an example of we could have gone in, given the owner $1 million to go away. There were some prepayment issues on that loan. You had to carry it for a couple of years, but we would be 96% leverage from day one and use cash to carry ourselves through that period of time till we could pay the loan off and then put better financing on and then build the project, reposition the project. So, these are the types of things we're seeing. And then the deal I talked about in Little Rock, probably falls more into Fund 3, but it would qualify maybe for Fund 4 as well. But the difference between Fund 3 and 4 is Fund 3 cannot acquire debt. Fund 3 has a cap on the amount of leverage we can use in the properties. Fund 3, when we purchase in Fund 3, we expect there to be cash flow from day one, and that's typically in the 7 to 9% range. This could be irregular cash flow, not as often. So there are some pretty big distinguishing points between the two funds that we think are pretty evident. And there's additional details in the PPM when y'all get a chance to review it. So that takes us through to a little summary on ApexOne for those of you that have not been with us for a while. This is our 4th fund. We have 3 funds out there right now. Fund 1 is in its harvesting stage. We've sold 9 of the 13 properties. We have 2 others we're selling this year. That was a $16.9 million fund. We've already returned about $23 million to investors, and we'll probably throw another 7 to 8 million out of these remaining properties, maybe a little more, based on some of the initial underwritings we've seen. That property is, that fund is doing a 14.2 IRR. Fund 2, we're in the operating stage. We are beginning to selectively harvest properties. We've sold 3 at great returns. That fund raised $55 million. We've already returned $36 million to investors, and we have 12 properties left. We have 3 of those that we're in the process of putting on the market. 2, I think, will sell by the end of this year. The return on that fund is 12.9%. Because we've just started harvesting the properties, we've been currently 8% yield on that fund for some time. In Fund 3, which a lot of you are in, we have 9 properties in the 10th under contract. That's a $108 million fund. Our goal is 100. We went past that. We've acquired $330 million of assets. The returns we're looking at on that fund are 13 to 15% and a 2 multiple. And so that fund is just beginning to generate strong cash flows. I think last month's distribution was 8% to investors. Fund 4, we're in the formation stage, obviously. Looking to acquire 15 to 20 properties. About 250 million is our goal we're shooting for. That can go up to 300. We have a couple of pretty large investors that are speaking with us, and we're in papers with a couple of those. Portfolio loan to value, we're shooting for about 60 to 70% leverage is where we'd like to be. A 16 to 18 IRR and a 2 to 3 yield on that fund. And then these are the terms. I mentioned the target net returns are pref of 8%, projected yield 6 to 8. It'll be, like I say, a little irregular and unstable, but there will be cash flow. The target multiple, the fund life is 7 years. That's 5 years to hold the properties, 2 years to raise money and acquire the properties. The investment period is actually 18 months from the day of our first close. The minimum investment is $1 million. We waive that for existing investors, and we've usually been fair with the 506 group coming in. The asset management fee, this is a big difference, is on called capital. In our past fund, has been on contributed capital. So here, the asset management fee is only paid as we call and put the money to use. Something we are offering investors that come into the first close, we're going to lower that 1.25 to 75 basis points during the investment period. So during that period of time that we're out actually buying properties and calling money, we're only going to charge 0.75. That will boost your return a little bit in the fund. Our carried interest is at 20%. After the LPs receive your preferred return, we get 20%. If you receive your preferred return and received all your capital back, we then make 20%. There's a 50-50 catch up. And so those are the terms. And then I guess finally just showing you, this is our team. I think you all know Jim and myself. Tim Burns is our Director of Acquisitions, Chief Investment Officer. Bill Saul is our partner. Bill, by the way, has built about 12,000 apartment units. So we have good credibility there. David Steele is on our acquisitions team. Chris runs our asset management, 23-year, 24-year veteran with some big companies like Lincoln Property Company. Heather runs everything here at the office. When you can't get an answer, Heather's who you go to first. Ryan and Gwen are in the asset management, and then Kyle and Nick are in our acquisitions team as well. One question people have is, do you have enough people to execute this? Well, keep in mind, we are in the process of harvesting and selling off properties. And so as we sell those, we'll acquire others. But attracting talent to ApexOne has never been a problem. And not pictured here is we also have a full slate of people out on the marketing side, helping me with investor relations as well. In fact, I think Marla is on the call. So that's a little bit about the team. And just a little background, we're approaching our 10th anniversary next year when Jim founded the company in 2011. It doesn't seem like that long ago. It's interesting when I talk to a lot of our tax consultants, fund administrators, and I'm impatient about it. I want to keep growing. They go, you wouldn't believe the number of groups we've worked with that never got out of their first fund. So the fact that y'all are on your fourth fund says a lot about the stability and the returns. We've been fortunate. About 92 to 93% of our investors have continued to invest with us in all three funds. So we have good repeat investors. And Mark, I think that covers everything. Jim, did I miss anything you want to throw in?
No, I think we've got it covered. I'm be happy to do a little Q&A with the group, Mark, if you want to head down that path.
Sure. I guess just a general question. This is only going to be multifamily. There won't be any student housing in this fund. Is that the plan?
There's a couple of different ways to answer that, but if there was a large enough discount and the opportunity were great enough, we could buy a student housing property. As a general rule, we're a little down on student housing right now. It's gotten a little saturated, and it's attracted so much international capital over the past 5 or 6 years that we've foregone buying any student housing in Fund 3. And it would truly have to be a special situation for us to go chase it. But I never want to say never, because if a seller gets into a great deal of distress and the price starts falling off a cliff, it might actually make sense for a special situations fund to acquire a student housing deal, but it's certainly not at all a primary target. I don't know if Ernest wants to add something to that.
Yeah, I think, Mark, what we also want to do is, in the 506 team, we want to look and see what the landscape is. I'm pretty close to a lot of universities with some of the work I do. And the landscape of universities is changing. We don't know whether that's going to be permanent or what. For instance, most universities are not allowing doubles, triples, and at all. We even have some quad rooms. It's one person to a room. And what we're seeing is a big push to off-campus housing because there's nowhere else to go. So that could expand the dynamics in the student housing world. As Jim said, there's been a lot of construction in the student housing market. But what we're also seeing, our construction prices are going up. We're seeing starts cut in half. So there might be an opportunity. What I would, my 2 cents on this, is I'm going to have a really good understanding of what the school's plans are. Because I have a feeling once you take these kids, these students out of these doubles and triples and give them one person to a room, it's going to be hard to restack them back in something. I think the singles may be here forever. I want to see what the fallout is going to be. Right now I predict we're going to see an increase in enrollment with the slowdown in job growth. And so I think, that's going to give maybe another artificial expansion in students. But I think once the job growth comes back, we're going to see, the 18 to 21-year-olds like to stay. So I'd agree with Jim. It's going to be a really compelling story. It's going to be a compelling university. And it's going to be a heck of a deal for us to look at something in the student housing sector.
And on student housing in general, there's some in fun too. With a lot of schools going virtual and not having in-class learning, has that affected the lease-ups in this fall semester?
A little bit, but it's sort of been a tale of two cities. The schools that were slow in making a decision, we saw the lease-up slowing down, but now we're seeing activity pick up. We have one school, Middle Tennessee State University, that's 102% leased. Again, the school made an early decision, got the kids one to a dorm, and they pushed out. So I think the only school we have a little exposure to is in Fund One, Blinn College, but everywhere else seems to be, picking up. We're trailing behind a little, but the acceleration the last few weeks has been significant. And as the kids actually start arriving on campus, I think we'll see more. A lot of them just haven't signed up for student housing because they weren't sure what was going on with the school. But we're seeing a dramatic uptick in the lease up at these schools right now.
But do you see a potential short-term opportunity as these schools go virtual this year and eventually go back to not virtual, that they could
Well, that's my concern. Is this, is it really a black swan event or what? I want to see what percolates out here. I wouldn't go in right now just to buy for the sake of buying, unless there's a good solid asset to start with. That is, if I could get a Class A student housing location, within 500 feet of the entry to the University of Florida or to Auburn or Ohio State, and it was being sold at a discount because the developer had done something wrong and missed the lease up, and I could come in and buy it. I'd buy that all day long because Ohio State, Florida, and Auburn aren't going anywhere. Am I going to buy one 2 miles away in Kansas? I don't think so. Yep. I think the due diligence is going to be a lot steeper and more telling.
And what's your guess on the number of states that you may invest across in this fund? I guess as it gets larger, the potential is to go across more states, or are you going to stick with
I think so. But if you start looking, going back to our map, we've really been a southeast focus because one of the things that we've talked about is climate, and that's going to be a southeast, and that's where the job migration is. That's where a lot of the research laboratories are. That's where a lot of the university research centers are, like the Carolinas. So if I had to guess, maybe 7 or 8 states. We like Florida. I mean, Florida's Florida. It just continually is astounding and recovers well. We like the Carolinas. We have done extremely well in the Carolinas. Tennessee has been a very good market for us. We looked at a couple of deals in Virginia because we think, in Maryland, because we think no matter what happens in DC with the election, there's going to be an expansion of government in those roles there. So, I don't think we're going to be on the West Coast. I never say never, but I just don't think that's going to be our bailiwick. I think we're going to look at the Southern strategy more than, if I had to guess, I'd say we're going to probably be in the South and the Mid-Atlantic states.
All right, and then there's a question about the 50-50 catch-up. I mean, essentially, you pay the pref, and then you catch up to the 20% at a 50-50, and then after that, it's split 80-20. So it's just until you get to 20%, it's a 50-50 split.
That's correct.
All right, and pre-submitted question about the Fund 3 is you've already called 40%, and so I guess there's potential for Fund 3 and Fund 4 to compete against each other. Is there any
I don't reasons? Yeah, I mean, there's always that's a great question, and we tried to make the funds distinct enough. But I think what you're going to see, and Jim, jump in on this if you want to, but I think there's 2 groups of sellers out there, or 2 groups of owners right now that'll become sellers. There's people like ApexOne, where we don't have to sell our assets at a discount to move them. we're going to sell them at the price and we're going to stay the course. There are sellers out there that are still selling value add workforce type opportunities that they don't have to discount, but they're just going to sell because it's that time and they can capture. That's what Fund 3 is trying to buy, where there's still good, strong cash flow, and we can apply that. And I think what's going to happen, if I had to guess, we've got the deal in Little Rock tied up. We're going to close on it. If I had to bet, I think we're going to find another deal, because these brokers are calling us and we're looking at deals, all around the Southeast that are off-market transactions that, so I think another one of those are going to pop by the end of the year. Last year, we closed 3 deals one on December 18th and 2 on December 19th. And I remember that because I got married December 19th and I'm wiring funds while I'm running down to get to my wedding. So we, it seems like there's always somebody that needs to sell in December. And I think we'll see some of that. Then I think the floodgates are literally going to open. And all these deals have been pent up that sellers wanted to sell for, like we are. We'd like to sell and get our money, back to our investors. They're going to bring those onto the market, and Fund 3 will be available to sell those. Then I think the distress is going to kind of trickle in for a while. So I could close on Fund 3. If I was a betting man, and I would say that we would have all of our capital committed by the second quarter of next year. I think we'll be finished with that fund. I think there's that kind of activity out there.
Okay.
And then I think for Fund 4, we're looking at, again, it wouldn't surprise me, because we've seen a couple of deals already. If there wasn't a buying opportunity this year and a chance to do our first closing this year, and once people know you have money, and these brokers, again, they're calling us, I think our investment period for this fund is 18 months, but the reality is I think we'll see some pretty fast traction on this and close it within 2021.
Will there be any assets, or potentially any assets, that you'd put in both Fund 3 and 4, depending on the size of it?
I guess we could, because the time frames would run parallel and they're both well funded. We could do that, but it's not our objective to do that. When you see these deals, they're very distinctive.
No, excuse me. I said the honest truth on that, Mark, and what popped into my head was, it's possible that a Fund 4 asset might fit into Fund 3 as well, although the underwriting's a little different. A Fund 3 asset's not going to fit into Fund 4, because Fund 4's returns are aiming to be a little higher, and because of the nature of the distressed seller situation. Can we say this in front of 36 people? It's a little bit difficult to know exactly how to describe the difference between 3 and 4, but I definitely will know it when you see it.
Jim, I'll say it. Jim doesn't want to say it. Jim's father's a minister. The Supreme Court justice one time said, "I can't define pornography, but I know it when I see it." And that's kind of the way these deals work. Is, yeah, that seems like a distressed seller, but someone see it. And let's take a real life example of how we process these. The deal in Little Rock, Arkansas. Okay, that was a distressed seller to some extent. And had we gone in and put 85 or 90% leverage on that deal, it would have met the Fund 4 requirements. We don't go in and put 80 or 90% leverage on a deal. We want to be in that mid 60s. That's how we keep it in there. So once you put that much leverage in a deal, you're actually stressing that you've now turned it into a stressed property, and that's what we want. So you can always do financial engineering to get the returns up, but you're just putting so much at risk by doing that. Now, let's say let's take that same deal, and let's say that it had a loan assumption with a significant prepayment penalty, and the buyer would take some money down. Fund 4 could go and assume that loan, put $1 million equity down, be 95% leveraged, and we would take that risk in Fund 4 because we've told investors we are going to take that kind of a risk. But I am not going to go out and place that kind of debt. And again, there's a fine distinction there. One, I'm buying from a distressed seller, and I know I have the cash to back that property and can work through the process and get the returns I need. So it's a good question. It's hard to give a very clear answer, but we are not going to financially engineer a property just to get these good returns, nor are we going to take a property that should go into Fund 3 that has good cash flow and throw it into Fund 4 just to seed it either. You'll start seeing a distinction between the properties, I believe.
All right. And there's a question on the discount for the first close. If you invest in the first close, but you add your investment down the road, do you still get the discount, the 0.75 versus 1.25, or is it only on that first close amount?
You'll get it because the discounted asset management fee lasts for the entire investment period, and the investment period stretches beyond the capital raising period. So at the point when the 0.75 would go away is beyond your capacity to actually put new dollars into the fund.
But if you put up 100,000, put another 100,000 in 6 months, does the second $100,000 get the discount, or only the first closing $100,000? I guess is the question.
You know, I would be open to consider that because I don't think anybody's going to make a decision just based on the closing, and maybe they have more capital that comes up, and you know, I would be inclined to honor that, especially to somebody who's coming to on the first closing.
I can tell you, you know what?
I'd be inclined to consider that.
We can do that.
All right, cool. Good answer. We like those answers.
Just quit asking.
All right, and then can you clarify when the first close is and when we need documents signed?
We'd like to go ahead, Ernest.
Yeah, I mean, I think it's hard. We won't do the first closing until we have a deal. In theory, we could do a first closing and just not call any capital. But I think a lot of it is going to stack up by, what our commitments look like. Let's say we've got a couple of pretty large investors that are making sizable lead type investments with us. And, if we come out of the chute in the next 30 to 45 days with $100 to $150 million of dry powder available, we're going to start, hunting. And, when you think about, the equation we use is, we're not drag fishing. We're not we're not sitting that 6, 8, 10 mile netting out in the ocean and just seeing whatever we catch and what we like and throw those back. We're sport fishing. We know what we're going after, and we've relayed that to our brokers. But we've also told them we don't have the money right now because we don't want to burn our collateral with these brokers. But as soon as we know we have the money, we're going to put word out. And it doesn't take long for these deals to find us. So I'd like to see a close, an actual property closing by the end of the year, and with a couple more lined up to be jumping into the first quarter next year. Because the more of these we buy, the word's going to get out. We have money, we can perform. That's going to bring us deals. I think a lot of these deals you're going to see are be off-marketed deals. And Jim, one of the best apartment brokers in the country, he'll tell you when somebody needs to sell something in a hurry, you don't have time to go through that marketing process. You need to recover whatever you can. And so I think a lot of the deals we're going to be seeing is going to be from the relationships we have from brokers and not in the bidding war. But you've got to have the money to close that deal. And
the capital call schedule will be quarterly, or what's your guess on how that's going to go?
As we find deals, but we're also working with a couple of banks to get for lack of a term, a line of credit on the fund, so we could actually do an advance. So that way, again, depending on how much we raise initially, once we get that, we could pull the money down. And I would love to then go to quarterly draws and make it a little cleaner, have fewer draws and pull it in a little quicker, or maybe even monthly if we have some things stacked up. So that's our objective.
And what kind of track record do you have on buying distressed assets like this? Either buying the debt itself or whatever comes up.
That's a good. We've actually bought a couple of distressed properties in the fund. The property in Tallahassee that we own, that is, we just refinanced to a 33% return. That was a distressed property. It was from a distressed seller. It was a group trying to do a conversion from student housing to conventional and just screwed it up. And we bought it at a big discount, turned it around. It was the community of the year in Tallahassee 2 years ago. And, it's just been great. So our team has experience in doing that. Myself and Tim, we were both with big syndicators and investors, and in both of our previous lives, we've bought notes. In fact, I actually managed a portfolio of loan foreclosures when I was at PM Realty Group. I managed, there was 35 properties that we foreclosed on and managed through that loan foreclosure process. So we've done that. Now, keep in mind, we are not going out to acquire debt where there's going to be a fight, a battle royale with the last man standing. We're looking at acquiring debt where there's a very clear path to ownership. We don't want to waste money and have nothing to show at the end. This is where we can go in with a distressed seller, fix their problem, give them some money to go away, go through the process with the bank. Again, we are a select sponsor, which carries a lot of credibility in the lending community. So we're not going in to fight and battle and be in court on these loans. It has to be a very, very clear path to ownership, or we're not going to get involved with it.
All right. And is there any concern about trying to catch a falling knife with some of these deals? Maybe more discounted in a year versus 3 months from now?
I don't think so, again, because I think what was driving those discounts, for those of you that were in the real estate industry back in 2008, and I was, without revealing, Jim and I have been through all 5 of the last recessions in real estate. We don't even lose sleep anymore. What drove those big discounts? It wasn't because the properties fell in value. I mean, the tenants were still paying rent. A lot was going on. You just couldn't finance those properties, and the banks were taking these things back left and right. And the last thing a bank wants, any of you guys in the banking business know, you don't want real estate owned on your balance sheet. It hurts your lending capacity. So they were discounting and selling these things left and right. And then there's the combination of the overbuilding in the market and what's happening there. So I'm not as worried about a falling knife because I just don't think we're going to see those discounts. I think the people that are sitting on the sideline waiting for the bottom to hit those 20% discounts, whatever, I think they're going to just be standing there holding their money at the end of the day and pass on the opportunity. That's why we did that fairly extensive analytics on how much discount do we need to get these returns. And again, I think you're going to find Jim and myself and everybody at ApexOne, we live on the philosophy that pigs get fat and hogs get slaughtered. We don't mind getting fat. We just don't want to get slaughtered. And I think the people that are waiting on the quote bottom and think these big discounts are going to be there, they're going to get slaughtered. And in the meantime, we think we can generate these returns. So I'm not worried about that because the dynamics leading into this recession are so vastly different than the 2001 and 2008 recession.
Well, there's quite a bit of liquidity in the market this time around, which is probably why the stock market hit a high yesterday again, which was completely different than the liquidity that was missing in the market back in 2008 and 9. And it's going to keep prices somewhat in check. There's definitely discounts on the stuff that's trading right now, but we just don't see how those discounts are going to get down to 60 or 70 cents on the dollar. You can buy something less than replacement cost and capitalize it with debt less than 3%, and you've got good strong partners and good strong asset management like we do. We'll be very, very well positioned because replacement cost 6 or 7 years from now is definitely going to be higher than it is today. So if you can buy it on a discount to today's replacement cost, when we become sellers on this fund a little bit down the road, I think we're going to be in a really good spot.
Now, I think it also goes back to the statement I made earlier about what we're out fishing for. We're big game fishing. We're not looking for 20-year-old properties or even 15-year-old properties or 10-year-old. We're looking for newer properties that have a good long life cycle left in them. And we don't think those projects could be discounted. I don't want to buy a 20-year-old community that's on its 3rd renovation or lease up on this. We're really looking for newer properties that we can get, as Jim said, at a significant discount to replacement. So, that's also a little different. I just don't think new projects are going to get the deep discount that you saw in the previous cycle.
Do we see construction prices coming down at all? I mean, the theory going in was when the recession hit that new construction would almost cease and maybe construction would be cheaper down the road, but it doesn't look like that's the case. Maybe you can add some insight.
I just saw an article today from one of the National Real Estate Investor publications, and exactly the opposite is happening. So here's what's happening out there in the construction world right now. Typically, housing is one of the leading drivers bringing a country out of the recession, and we're seeing record single-family home starts. and again, we're not that worried about how that impacts multifamily for a lot of reasons. But a lot of the construction is going towards the single family housing. There has been a dramatic decrease in money allocated to multifamily. In fact, I've seen starts being, basically cut in half over the next 2 years, and so we will not see a real surge until 2023, because typically it takes 2 to 3 years to get these large projects like this through the approvals and all you have to do with the local communities to get something like this built. But what we are seeing, think about it. You're hearing stories of rising minimum wage, $15 an hour. That's going to take cost up. You're talking about some green initiatives in the construction industry. That always drives cost up. I haven't heard of anything that's going to drive costs down. Materials, supply, labor. I think the one argument you could make is, will you see a discount in land? Will people be needing to sell land to get their money back? Most people I know that own land, especially land large enough to handle a multifamily project, they don't need to sell. They're holding. That's just part of their inventory. And also keep in mind, about half the new apartments that are built are actually developed on old apartment sites. So those would have to come down. So that adds cost as well. So I have seen nothing that is talking about a retreat in construction prices.
We kind of mentioned it before we started, but as far as this particular fund, what would be the repercussions of a Democratic takeover of the Senate, the House, and Biden winning, as far as what it might do to the economy and potential targets?
So there's, again, it's a tale of two cities. If you look traditionally, our rents have grown the most under a Democratic administration. And the reason for that is they want to spread the same amount of money over more people. During a Republican administration, which tends to be more tax favorable to the investors, I think you see returns, move up a little more, and there's more incentive to build, et cetera. There's a part of me that says this fund actually might perform better under a Democratic administration. But I think you can make the offsetting argument that under a Republican administration, where there's more favorable tax laws, and I think for one thing, I think Biden has indicated that he is looking at eliminating the 1031 exchange. So there's going to be some different money, looking at property. So I'm not losing sleep over what it means to our portfolio. I think that even increasing the wage to $15 an hour, what you're going to see there is just a quick overview on our industry. There's three sectors. There's affordable, workforce, and lifestyle housing. There are 5 million families that would qualify for affordable housing if it was available. That is, people making less than $36,000 a year. That's how much shortage is. So if you're a family making less than $36,000 and you get a nice increase because of minimum wage, and you suddenly can move into a community with better schools, a newer property, such as our workforce housing communities, you're probably going to do that. Closer to your office, closer to where your wife works, you're going to do that. I think the difficult part is what happens at the higher end, the super expensive communities, how those fare. But we think that spreading more money around actually helps alleviate some of the housing issues we're seeing in the country.
Right, and then how much of capital, how much equity will you put into the fund out of the $250 million, you and Jim and the other principals?
We have
Minimum of
$2.5 million.
$2.5 million.
2.5. When you start spreading these among 4 funds, you're somewhat limited, but that's pretty typical in our sector. And that's what we commit to. We've always committed to 1% in our funds, and we've always said, well, I think we did 2.2 in Fund 1, about the same in Fund 2, and I think in Fund 3 we're about 2.3 or 2.4 million.
All right, and then have you discussed putting this on platforms like Fidelity and Schwab, the alternative investment platforms?
It will be. We're on all their platforms. We have everything we need to be on any. We're on their platforms, and if somebody has some other investment platform, we're members of a group called DTCC, which is a distributive something clearinghouse. Basically, we can move banking information through DTCC to whoever you bank with. And of course, we have our ACH system, which transfers real quick as well. But yeah, we'll be on all the major. We'll be on NFS, Schwab, you name it, we'll be on them.
And do you do your own in-house property management, or do you use third party? Or I guess JVs on some of these, right?
We use third-party managers. Typically, our managers co-invest with us. We like them to have a little skin in the game. We have four that we use on the conventional, and 3 we use on student housing. And that is such a high-touch sector of the industry. I've worked for a company that had a management company, and you spend well over half your time managing the management company. These people are pros. I mean, the example I use is if we wanted to start an in-house management company, we probably could. But when you're Balfour Beatty or the Collier companies or the other groups we use, and you're sending your people to training every quarter, and you've got a backup property manager so that if one of your managers is injured and can't work, or they're pregnant and need some time off or have family time, they have somebody, a backup pro that can go in there and not miss a beat. The other thing I like about them is they're constantly training, young people coming into this industry, so that when we buy a property in Panama City, Florida, they might offer, one of those young trainees the chance to move over, and they already know our system. They know how we operate. They can hit the ground running from day one, as opposed to me going out and having to hire somebody to take over that property. They're pros at what they do. Our inclination is, unless we were big enough to be able to have that support, we want to keep using third-party management to the extent we can. As a check and balance also, I know a lot of companies are vertically integrated, and I get that. And if we were going to own properties long-term, I'd certainly be in favor of that. But, if one of our management companies isn't doing a good job, we can fire them and replace them. And we've done that. So that just makes them work a little harder at the other properties. So it's nice to have that flexibility. I think they work for us, which means they work for the investors, and it's one less conflict.
All right. And then what is the minimum for this fund for 506 members?
That's your question.
We'll drop the $1 million down to 100,000.
All right.
And Mark, Ernest, and I were talking about this earlier today. It can get kind of expensive from time to time handling small investments because of the cost of moving the money around and stuff. But Ernest told me to make the decision on this. So we would allow a $50,000 investor to come into the fund as long as we can deliver your distributions through check or ACH. If it ends up being something out of an IRA or something, or a strange entity that requires us to send a wire, I don't want to pay $25 to send some guy $45.
Oh, makes sense to me.
And so we're going to kind of draw the line at that, so that it doesn't, so the expenses actually don't take a gigantic bite out of the amount of money that we're moving around. But we'd be happy to have you bring in 5,000 people at 50,000 apiece.
All right.
If I can press a button and send them an ACH, Ernest, I'll stay in the good graces of Ernest.
All right. Fair enough. And then, so if people want to invest, what are our steps? Who do we reach out to? What do we need to do? Is it going to be DocuSign, or is it going to be the old-fashioned way?
It's going to be set up. We'll have a portal that's we have our in-house portal, hosted by a company called Juniper Square, one of the leaders in the industry, and it'll all be done. In fact, we've actually refined it. We've worked out a couple of little kinks we had before, and so it'll be a very smooth process to go online. Everything's done, rather online. You don't have to pull out. You can do it on the phone on the way to the airport. You don't have to pull out a pen or a piece of paper or anything. Just click and sign.
Very good.
Ernest, when do you think we'll have that set up? Will it be by the end of the week or the first part of next week?
That's set up. We're just populating some of the forms in. I'd say to be safe, probably the middle of next week, but we'll send out an email. We have all the 506, Mark. We'll send out an email to you as soon as it's open. And we have to invite people in. They have to be accredited investors, so we'll go through that process. But anybody that's in already, you'll probably get an email that lets you know. By the way, speaking of emails, a lot of you who are already investing with us, we're going to start a series of this same presentation with the other investors, the non-506 groups, starting next week. And so some of you may get a duplicate invitation. So we're not trying to go around the group. Just as an investor, we want to make sure that you see everything. And so if you want to listen again, you're more than welcome to. but otherwise it'll be a duplicate. But we'll also let you know to those existing investors when the portal is open. And Mark, to those that are new, I don't know how you and Jim do this. If you let us give us information, whatever, we'll certainly make it available to them as quickly as we can.
Right. And they probably need to identify when they invest that they are 506 members.
Absolutely. Get all the benefits.
But they can sign
Mark,
the documents now, but we probably won't fund until 2, 3, 4 months down the road.
That's correct.
All right. Very good.
3 anyway.
Yep.
3 anyway. Mark and Ernest, if you want to flip it to the last screen that shows our contact information. When folks get ready to ask additional questions, if they're welcome to call me direct. And Ernest my phone number is 713-231-1420.
You can also go to the ApexOne website, and all our contact is just, if you just remember ApexOne, you'll find us. And our contact, our phone numbers, our email, everything is on the website. So you can't miss it. Mark, feel free to post it to whomever.
All right. Sounds good. Well, thank you for your time. It was very informative, and I'm sure you will be hearing from lots and lots of 506 members.
We appreciate everything y'all have done. You've been a great group to work with. You always ask good questions, and we appreciate the friends. Y'all referred some people too. So thank all of you for what you do to make ApexOne successful. We appreciate it.
Very good. Stay safe. Stay cool.
Thanks, Mark.
All right,
well.
thank you, guys.
Bye, everybody.